Right now, as this is being recorded, a single sentence spoken on television is sending stock market futures falling within seconds. Nothing about any actual company changed in that moment. Not its earnings, not its factories, not its customers. Just the mood did. By the end of this episode, you'll understand exactly why that happens, and why so many people sell in a panic even when nothing is fundamentally wrong. This episode isn't about any single news story. It's about the psychology underneath every panic-driven market drop, using what's happening literally today as our live, real example. Here's what happened, stated plainly. The U.S. president made a comment about an ongoing geopolitical situation. Within seconds, stock index futures dropped. We're not going to spend this episode on the politics or the underlying conflict itself. That's not the lesson. The lesson is what happens next, inside every investor's head, the moment a headline like that hits. Think about what actually happened to the businesses inside a falling index in that moment. Their factories are still standing. Their employees still showed up to work. Their customers didn't cancel their orders. Nothing about the actual underlying business changed in those few seconds. Only the price did. Part of this is genuinely rational. A stock's price reflects not just what a company is worth today, but investors' collective guess about its future. So, real news that changes the outlook for tomorrow can legitimately move prices today. But that rational piece is usually much smaller than the emotional piece that follows right behind it. Here's the less rational part. Fear itself spreads through a market like a contagion, often faster than the actual information does. Someone sees the price falling, assumes something must be seriously wrong, and sells, which pushes the price down further, which convinces the next person the same thing, and so on. The selling itself becomes the reason for more selling. This has an actual name: loss aversion. Decades of behavioral economics research has found that losing $100 feels roughly twice as painful as gaining $100 feels good. That asymmetry means fear of loss is a far stronger emotional force than hope for gain, which is exactly why panic spreads faster than optimism does. Neurologically, fear takes a shortcut. Your brain has a fast, reactive threat detection system and a much slower, more deliberate reasoning system. A scary headline can trigger the fast system, the one behind the sell now impulse, before your slower, more rational thinking even has a chance to weigh in. There's a social layer on top of all this, too. When you see other people selling, it feels validating. Surely they know something you don't. This is herd behavior, and it's powerful precisely because it doesn't require you to have any actual new information yourself. You're just reacting to everyone else's reaction. One more bias worth knowing: the availability heuristic. Our brains judge how likely or important something is by how easily we can recall an example of it. And a dramatic, emotionally charged headline is far easier to recall than a quiet statistic. That's why a single scary sentence can outweigh years of steady, boring fundamentals in an investor's mind, at least in the moment. History has seen this exact pattern play out dramatically before. On October 19, 1987, the Dow Jones Industrial Average fell 22% in a single trading day, still the largest one-day percentage drop in its history. Decades of analysis since then have never settled on one clear fundamental trigger. Much of it was simply panic feeding on itself. In March 2020, global markets fell more than 30% in a matter of weeks as COVID fear spread. And yet markets fully recovered those losses within months, well before the pandemic itself was anywhere near over. The panic, in hindsight, had priced in an outcome far worse than what actually unfolded. This isn't a one-off coincidence. Across decades of market history, panic-driven crashes, the ones with no single clear, fundamental cause, have tended to recover meaningfully faster than crashes tied to a genuine, lasting change in the economy. Fear, it turns out, is a worse long-term predictor than it feels like in the moment. Zoom out far enough, and this pattern becomes almost absurd. The Dow Jones Industrial Average has lived through dozens of panic-driven plunges across its history. 1987, the dot-com crash, the 2008 financial crisis, the COVID crash, and plenty more most people have already forgotten entirely. And after every single one of them, once the fear passed, the index went on to make a brand new all-time high. In the moment, each one felt unprecedented. Zoomed out, the chart tells a very different story. Here's the part that actually costs people money. A price drop on paper is not a real loss until you sell. Panic selling takes what might have been a temporary, recoverable dip and locks it in permanently, right at the exact moment the price happens to be at its most painful. Multiple long-term studies have found that missing just the market's 10 best trading days over a 10-year period can dramatically cut your total return, in some cases by half or more. And here's the cruel twist. Those best days, statistically, tend to cluster in the days and weeks immediately following the worst, scariest ones. Panic selling during the scary part means you're often selling right before the recovery begins. In the exact same moment that retail panic selling accelerates, a meaningful amount of institutional money is often doing the opposite, treating the panic itself as a signal about other investors' emotions, not about the company's actual worth, and buying accordingly. There's a well-known piece of investing wisdom, often attributed to Warren Buffett, that captures this: the idea that it pays to be cautious exactly when everyone else is excited, and to stay calm exactly when everyone else is fearful. It's easy to say and genuinely hard to do, which is exactly why it works for the people who can actually do it. Here's something practical you can actually use. Decide your investment thesis and your plan for a downturn calmly in advance, before anything scary happens, not in the middle of a panic, when your fast, reactive brain is already in charge. A decision made in a calm moment is far more trustworthy than one made in a frightened one. When a scary headline hits and you feel the urge to sell, ask yourself one honest question: has anything about the actual underlying business genuinely changed? Its earnings, its competitive position, its customers, or has only the mood in the room changed? That single question won't always give you a clean answer, but it forces the slower, more rational part of your brain back into the conversation. One more honest, practical note. Research on investor behavior consistently finds that checking your portfolio more frequently during a downturn increases anxiety and increases the odds of an emotional, panic-driven decision, without improving your actual results at all. Sometimes the most effective action is simply closing the app. Let's pull it together. Prices react to real news almost instantly, but fear itself spreads even faster than the actual information does. Loss aversion means losses hurt roughly twice as much as equivalent gains feel good, which is exactly why panic outruns optimism. Historical panics, from 1987 to the COVID crash in 2020, recovered faster than the fear at the time made them feel like they would. A loss only becomes permanent the moment you actually sell. And the single most useful defense against all of this is deciding your plan calmly, before the scary headline ever hits, not in the middle of it. So we've seen what happens when fear runs far ahead of the actual facts. That raises the natural next question. What happens when the fear and the underlying reality actually do line up? When something is genuinely, seriously wrong? Next time, we go back to a moment in market history where that was exactly the case. If this helped you understand why you feel the urge to panic sell and gave you something practical to actually do about it, please hit that subscribe button. It's completely free, and it's the single biggest way you help this channel grow. See you in the next one.